Technical analysis for beginners, volatility contraction pattern. Listen carefully. If you keep buying breakouts and price immediately reverses, it is not bad luck. It is not market manipulation. It is because you are entering when volatility is expanding too late, instead of positioning when volatility is contracting quietly. Today, I will teach you how to identify, validate, and trade the volatility contraction pattern properly so you stop chasing random breakout candles and start executing structured, high-probability setups with defined risk. By the end of this lesson, you will have a repeatable checklist, not a guess, a checklist. Let's begin. Most beginner and struggling traders make the same mistake. They see a strong bullish candle. They see momentum. They feel urgency. They enter. No structure, no confirmation, no defined invalidation. And when price pulls back, they panic. This is emotional breakout trading. This is why accounts slowly bleed. Here is the truth. Breakouts do not fail randomly. They fail because there was no pressure buildup. The volatility contraction pattern, also known as VCP, is a breakout strategy built on compression before expansion. Write this down. Compression leads to expansion, always. So what exactly is a volatility contraction pattern? Simple explanation. Price is in an established uptrend. It pulls back, then rallies, then pulls back again. But each pullback becomes smaller than the previous one. Volatility shrinks, range tightens, selling pressure decreases. That shrinking range is not weakness, it is absorption. Supply is drying up. When supply dries up, even small demand creates expansion. That expansion is your opportunity. This is technical analysis for beginners done correctly, not indicator overload. Structure first. Now let's break down the objective criteria. No guessing, no emotions. Rule number 1. There must be a strong prior uptrend, higher highs, higher lows, clear bullish structure. If the broader trend is sideways or bearish, it is not a valid VCP. We trade continuation, not hope. Pause. Rule number 2. You need at least 2 to 4 contractions. The first pullback may be larger, the next one smaller, then smaller again. The percentage decline from high to low should decrease. That is measurable. That is objective. Rule number 3. Volume should decrease during each pullback. This is critical. If volume increases during pullbacks, that suggests distribution, not contraction. Smart money accumulates quietly, not aggressively on red candles. Rule number 4. There must be a clear resistance level, a tight breakout line. You must be able to draw a horizontal level where price repeatedly stalls. This becomes your trigger. Rule number 5. The final contraction should be tight. Narrow candles, small ranges, low volatility. This is pressure building. Think of a spring compressing. The tighter it coils, the stronger the release. Now listen carefully. This is where beginners fail. They see tight candles. They assume VCP, but they ignore context. Validation checklist. Is the higher time frame trend bullish? Is the asset outperforming the overall market? Is volume drying up into the base? Is the pattern forming near highs, not deep below resistance? If price is 30% below its highs, that is not a VCP. That is a weak bounce. Professional traders filter aggressively. Amateurs trade emotionally. Decide which one you want to be. Now let's talk about entry. This is important. You do not enter during contraction. You wait for expansion. The entry trigger is a breakout above resistance with volume expansion. No volume, no trade. Volume confirms demand. If breakout happens on weak volume, stand aside. Patience is a strategy. Optional advanced execution. Enter partial size on breakout. Add on tight consolidation above the breakout level, but only if volume supports continuation. Never full size blindly. Now let's define risk. This separates professionals from gamblers. Your stop loss goes below the last higher low inside the contraction, or slightly below the breakout candle low for tighter control. It must be structural, never random. Position size must adjust to risk. Risk only 1 to 2% per trade. If your stop distance is wide, reduce share size. Small accounts survive through discipline, not aggression. Now, profit targets. There are 3 structured approaches. First, measured move. Measure the height of the base, projected upward from breakout. Second, trailing stop under higher lows. Let the trend pay you. Third, risk to reward model, minimum 2 to 1. If you risk $100, target at least $200. Anything less is statistically inefficient. Trading is math, not emotion. Let's talk about psychology. Why does the volatility contraction pattern work? Because markets move on supply and demand imbalance. Early buyers accumulate, weak holders sell during pullbacks. Each pullback removes more sellers, fewer sellers remain. Pressure builds. When demand finally increases, there is little resistance. Expansion happens fast. You are not predicting, you are aligning with imbalance. That is professional trading. Common beginner mistakes: entering before breakout, ignoring volume behavior, trading VCP inside downtrends, oversizing position, chasing extended breakout candles. If the breakout candle is already stretched far above resistance, do not chase. Wait for pullback. There will always be another opportunity. Impatience destroys edge. Now here's your execution playbook. Step 1, confirm strong uptrend. Step 2, identify 2 to 4 contractions. Step 3, verify decreasing pullback size. Step 4, confirm declining volume during contractions. Step 5, mark resistance clearly. Step 6, wait for breakout with strong volume. Step 7, enter with defined stop below structure. Step 8, manage trade with at least 2 to 1 reward potential. Simple, repeatable, structured. Imagine the transformation. Instead of chasing green candles, you wait for compression. Instead of reacting emotionally, you execute systematically. Instead of random entries, you trade high-probability chart patterns. This is how struggling traders become consistent traders, through structure, through discipline, through defined risk. Before your next trade, pause. Ask yourself, is volatility expanding randomly, or has it been contracting strategically? If you cannot answer that clearly, do not trade. Master the setup, master the checklist, and remember, professional traders are not paid for activity. They are paid for precision. This is Online Trading Hub, helping beginner and struggling traders build confidence and consistency by trading with structure. See you in the next lesson.